There's $165 billion in outstanding private student loan debt in the United States alone. The average student receives an interest rate just under 10% on this private debt. I'm Josh, one of the co-founders of Remotize, which is a marketplace that provides students alternative loan solutions for school funded by everyday investors. My co-founders and I just graduated from the University of Michigan. We started this company after having a conversation with one of our fellow classmates. She told us that she received the same interest rate and loan terms on a private loan her senior year as she had her freshman year. This just didn't make sense to us. She had a good major with a high probability of employment, as well as good earning prospects, and she had demonstrated that she was going to graduate on time. And yet, the private lender either failed to or chose not to recognize that as she progressed through school, she became a more creditworthy borrower. Really, what our friend's story highlights is a fundamental flaw in the current paradigm of student lending. Student loans are markedly different than all other loans, and that by giving a student a loan, you are actually improving his or her risk profile. That is, on average, an investment in an education is a good one, and it therefore makes sense to understand how when giving a student a loan, how giving a student a loan is going to affect their future ability to repay that loan. Students all across the country are receiving high interest rates and inflexible loan terms from private lenders who are reliant on the inapplicable, backward-looking FICO score methodology to assess student credit risk and cosigners to guarantee these student loans. Students first go to the financial aid office at their university in order to get funding for school. And this is almost never enough, so a student then has to go to the federal government to get a loan for school. And again, oftentimes, this funding is not enough. So a student finally has to turn to the private sector in order to fill this final gap in funding. It is here in the private sector that over 1.85 million students are denied financing every year simply because they lack a cosigner. This is where Remotize comes in. Our solution takes the form of a marketplace. Students first choose from one of our loan templates and customize it to their unique needs. The student then receives a commensurate interest rate and credit score that's generated by our forward-looking credit risk model. The student then posts their loan request to the open market, and finally, they receive funding from investors. This initial capital is being funded by alumni who are looking to make an impact while also making a return on their money. As well, we do not require students to have a cosigner in order to get a loan. Powering all of this is our forward-looking credit risk model, which predicts a student's future ability and willingness to service this debt. Our model is based on a number of non-traditional, forward-looking factors. Things like the university the student is attending, their major, their GPA, all things that help us understand their future ability to service this debt, as well as other non-traditional behavioral factors that help us understand their willingness to service this debt. For example, our model has learned that students who are taking over 15 credits every semester have a higher GPA on average, as well as a higher likelihood of graduating on time, which is really the largest risk when lending to a student. As well, our model understands that students who work between 10 to 15 hours every week while in school actually have better academic performance, again, are more likely to graduate on time. As well, they earn more post-graduation versus students who are not working while in school. No other lenders today are considering these factors when lending to students. But we do, and because of that, we're able to expand access to credit and loan to more students who otherwise would be denied financing. Our model is based on 20 years of data and 200 million data points. It's back-tested on all this data to make sure it's validated and making accurate predictions. Our competition can be thought of as kind of put into one of two buckets. You've got your kind of larger existing players, your big banks, your Wells Fargo, PNC, and you've got your newer online lenders who are sometimes peer-to-peer. The main distinction here, though, is that our competitors are reliant on the FICO score to assess credit risk, and they're reliant on cosigners to guarantee these loans. We generate revenue by taking a small fee on both sides of every loan transaction, Students pay a 2% loan origination fee when the loan is funded, and investors pay a 1% fee on all payments received from the borrowers. We're currently raising a $500,000 seed round, which will help us launch our private beta, as well as maintain regulatory compliance with the vast US regulations. I'm Josh Shifman, the Chief Data Officer and a co-founder of Remotize. I just graduated from the University of Michigan with a degree in computer science and statistics. I'm leading the development of our credit risk model. I spent the past 3 summers at a venture-backed startup building machine learning models to solve business problems. As well, I'm excited to announce we've just added Michael Carver to our advisory board. He's the Chief Loan Officer at Lenny Financial, as well as Head of Credit Operations at Lend Street Financial. Like I mentioned, we're raising a $500,000 seed round, and we'd love to chat if you want to come along on this ride with us. Thank you.